Hello, everyone. Welcome back. So today's a very special day because today I'm starting a special series of alumni reunions here at Claudia's YouTube channel. And I have as the first ones, so thank you first for being the kind of experiment with me, the '06 alumni here. Which vintage are you guys?
06D.
06D. Okay, so it's my pleasure to welcome JJ Chai and to welcome Professor B, also Balazs Fogoly.
Yes.
So I tried to get this right. So thank you both so much for making time. We're here at INSEAD in the Singapore studio. And what we want to talk about, really, both of them are successful entrepreneurs. We want to really understand what they are doing. And in the conversation, I'm going to kind of try to relate it back to value creation in the context of private capital. But really, it's about both of you. So JJ basically lives the realities of scaling, growing a business. You've been the founder, you are the founder, you continue to be the CEO of your startup, and we will hear a lot more about it, or I should say the scale up. So operator's battlefield is what comes to mind when I look at what you are doing right now, and we hear a little bit more about it in a second. So Balazs, you bring basically decision-making or decision-taking under risk, really under one umbrella. And interesting enough, you use poker to teach people how to take risk, how to balance risk, and how to avoid risk. Mm-hmm. Is this a fair description of what you are doing?
It's fair enough. It's fair enough. So it's a lot more complex. So I bring in elements from psychology, neuroscience, decision sciences, obviously. It's replicating how poker players think and teaching business people how to have that kind of mindset.
Okay. And who kind of comes to you? What kind of, who calls you? Is it corporates? Is it individuals that say, I need to learn more about myself, or?
Yeah, I would say there are two types of clients. I'm always doing B2B, so it's a whole company hiring me. There are two types of clients. Ones who want to do something different, right? It's fun, it's exciting, so they want to see what they can do with it. So they love the concept, and they figure out what to do with it. And the other one is where they need to change something about how they make decisions, whether it's taking more risk, taking less risk, it's about learning from risk, it's about appreciating failure. There are so many different ways we can use this.
Okay, very interesting. So let me jump to JJ. So JJ, 5 years in, you have founded, built, and grown a company called Rainforest.
Yes.
Tell us about that.
Yeah, so about 5 years back, we raised capital in the midst of COVID, actually, to buy and aggregate e-commerce brands. So at that point in time, basically the sort of backstory for all of this is that, like, if you think about e-commerce, it used to be only big companies could launch brands and products, which is you need a TV, you need sort of big production and so on, high capital requirements. But today, anyone can launch their own e-commerce brands. But a lot of them don't succeed. A lot of them get stuck in the sort of like 1 to 10 million range. We raise capital to sort of acquire these brands and start operating them at scale. So over the past 5 years, we've acquired 15 to 16 brands and operating at scale now, predominantly online, mostly to the US market.
Mostly to the US market, but you're based here in Singapore.
Yeah, the team is fully remote, actually, with a team all across Asia as well as the US.
Okay. Give me an example, like for one brand, pick any one of them that you kind of acquired where you saw opportunity in that.
Yeah, one example of a brand is one where we are actually going through a lot of changes now. But when we first acquired it, there's a brand called Lily's Love. Right? Lily's Love was a brand focused on toy storage. Its main product, its hero product back then, was a net that sort of stored all your sort of soft toys right in the house. Yep. Amazing numbers being sold every day on Amazon. It's amazing how many people have so many soft toys they can store it. But that was a hero product. And when we sort of looked at it, it was clear that like the previous owners, again, husband and wife team, had not optimized a lot of things, right? The sort of packaging, the amount of variations you could do with the product, pricing as well. It was best selling on Amazon, had the most reviews, and they were sort of selling it at on par with all the other players in there. So we took it over. We introduced new packaging, better packaging that sort of reduced cost. We introduced a lot of new colors to it, like it was in white. We had different colors, rainbow colors. Cost us 50 cents to color it. We could increase the price by $4, right, for a product like that. And a lot of optimization on sort of the online marketing side of things as well. So this brand grew by 3 times over the past 3 years that we've acquired it. And now we've sort of used that foundation to sort of pivot into a different segment, which is around sensory toys after storage. Yeah.
Mm-hmm. Interesting. So having done this, you said 14 or 15 times for different brands now over the last 5 years, right? So what is kind of like the one lesson, or maybe I should ask first, if you could go back 5 years and start again, is there anything you would do differently?
Yeah, one very obvious one would be not to have 15 brands. I would have much preferred to have 3 or 4 really good assets that we can actually work with. I gave the example of Lily's Love, but like for every one of those, I've got at least one other that didn't go as well, and we struggle with the, whatever we had in our spreadsheet around planning and all the growth levers did not work out, right? The Lily's Love is a great one. We sort of say, okay, we could acquire this. This is all the value creation levers that we do, and it worked out. But there's 2 more that like some of them halfway, and then some of them not at all, and it sort of goes into turnaround situations, right? So I would much prefer to have a portfolio today of 5 brands or 3 brands even, each much larger, than to have done 15. We just don't have the bandwidth and capacity or talent to create that much value across so many assets.
So be more selective?
Much more selective, much more focused, and don't overestimate how much talent you can build around to run so many assets.
Yeah. And what entity are you? Are you operating out of a holdco, or are you operating as a fund?
Yeah, we operate as a holdco. We set up as a private limited holdco, and we acquire all these assets, typically as asset acquisitions under our subsidiaries, and operate them. And the team is set up as, we also have a mix, but like now the teams are set up around like mini startups across each one of these brands, with some shared resources across all of them. Okay,
very interesting. So I will come back to you later on when we come talk about a little bit more about kind of going forward, what will be exit, what's your master plan behind that. So Prof B, so tell me what you have learned in running those poker workshops with clients, or maybe tell us a little bit, what do you kind of find more often than not in humans when they come to you?
Generally that we make terrible decisions most of the time. So there's a lot of room for improvement, right? Even successful people, they think back, okay, I should have done it differently, right? So there's so much room to learn, and we need to have a framework how to learn from this. These are smart failures we make, right? At least hopefully smart failures we make. But that's the best way to get better over time and make better decisions. If you look at in professional poker players, for example, they won't win every poker tournament. They won't even make the right decisions so many times. But they are not going to second guess themselves. They just, after the tournament, they sit down with their teams and they analyze crucial hands they made. And that's how they're going to learn to perform better at the next tournament. And leaders, managers, they need to replicate the same kind of mindset.
So learn from your mistakes in a smart way. Mm-hmm. Don't make the same mistake twice.
Yes, but that also requires that when you succeed, you have to understand it's always a mixture of skills and luck, right? So it's never fully skill-based and never fully luck. So if one of the biggest mistakes that people can make is when they succeed, oh, it was my doing, right? When they make a mistake, it was bad luck.
Yeah. So it was, in my space, it's usually, yes, we did an amazing job managing this asset. If not, it was the fault of macro, right? So couldn't have done anything else around it, right? So whether it was, I don't know, COVID related or anything else, so blame it on something else. Aside from, and I can see that learning to play poker forces you into those situations as you're playing again and again and again. Let's assume you get excited about it and you really enjoy that. So over time, I can see that you potentially approach decisions differently. Does it help to just have a workshop, like have done it once in a workshop environment? Does this make people change?
Oh, it drastically can make it change. If people have the right mindset that I'm going to take small experiments today, I'm okay to trust the people I'm working with, that everybody here wants to learn. So it's okay if we are sometimes don't know what to do because it's a new environment, but we are in a safe environment. So here it's all about applying what we learned. It's a sandbox, right? It's a kind of flight simulator. We don't want to just learn new concepts, go back to the office, and then experiment with it. That's dangerous, right? Here in a workshop, through poker, it's only the ego that gets hurt. It's not the bottom line.
Okay, interesting. So you're creating a safe environment. They can ask questions. They can take risks, little or large ones, and that's acceptable because they will see the outcome and can then discuss it, I guess, with the rest of the group.
Yeah, and this really comes in that most of the time I tell them what to do, how to change their decisions, right? And everybody keeps nodding. In the beginning, they nod, but they don't apply it. That's a very typical scenario that in my workshops, that they don't want to change really how they make decisions. They say, let others figure it out. I'm just going to do whatever I'm doing and then learn from that, right? Or that I just want to play. I'm not going to fold my hands. Just like JJ was saying that you need to have fewer brands, but focus on them better. This is the kind of selective aggression poker players need to do, right? If you play every single hand, it's going to burn cash for you, right? And the chance of winning, most of those hands will be losers.
Yeah. So it's interesting. I mean, that's why in an education environment, I prefer simulations over simple case studies, right? I mean, giving a talk or a lecture, like you said, people will nod to it. Once they walk out of class, what they actually do is a different story, right? I mean, you go back to your habits, right? And really only by applying what you do you have that kind of interest in it. Very interesting. I will come back on the kind of like simulation side and on how this applies to private equity potentially. If you basically, so we talked about JJ, about your kind of lesson learned. Don't kind of take too many bets using the other language. But if you could start the business again today, aside from not taking so many bets, anything else, any other lessons that you've learned in the process?
Yeah, I think the other piece around it was that like we were acquiring from sort of smaller businesses. These are husband-wife teams, they are founders, but not really sort of like, MBA grads or anything like that. So, we overestimated ourselves and said like, oh, this is run by husband-wife teams, small business, like we definitely can operate professionally. We've got like, people with experience in large organizations and so on. I think one of the things we underestimated was the founder essence in running a company is very powerful. Just the amount of determination, the real ownership mindset in there is really critical to sort of drive the business. Getting hired managers who come on board who sort of trying to manage performance reviews and KPIs are a different animal, and it's quite hard to set up KPIs and incentive schemes that truly mirrors a sort of ownership mindset. So in that world, I think in more cases which could have held on and kept the founding team where possible, I think that's probably one of the big things that we have done differently as well. In almost all our cases, we had exited the founders, put it on a professional team to run it. But I think in a few of those cases, we could have kept the team, done partial buyouts and so on. That would have been quite different, I think. And even today now, we're sort of looking at deals where we no longer sort of exit the founders.
Interesting. So, and how would you then, if you have a good example, how would you structure that? So you find this amazing brand that you feel comfortable with, that you can really add value to. It has a founder team in it. You said more often than not it's husband and wife, which is interesting, which adds another dynamic to the problem of just having a co-founder, right? And how would you structure it then? Because you're saying, okay, we have people that know how to do this, right? I guess they have to be willing to have the kind of coach in the room at a minimum, or co-owner.
This is where we've spent a lot more time trying to build a lot more of the infrastructure around like, hey, this is where we can really have value creation to you. So one of the things we've done over time, not just buy e-commerce brands, but to specialize in a specific category, which is in a mother and baby category, right, juvenile. Right. In that category, there's a whole set of things that's needed around compliance, regulations. There's also very common channels, so like being at sort of certain baby trade fairs or certain specialty retail stores for this. It's hard for any one company or small company to be able to do all that. They can be on Amazon, but trying to sort of also figure out Walmart or Babyliss and others is quite difficult. So that's where we're sort of building the infrastructure and say like, look, you can come on board, right? You don't need to sell your entire company. We're looking into something, in terms of structuring, 51% stake now based on some EBITDA multiple, and then over the next few years we start buying out based on, as we grow the brand. And you should be confident around growing the brand with our infrastructure because look, we have access to these retail channels, we have access to all these mom influencers, we have access to product development that will sort of really accelerate your business along the way.
Okay, so can I think of it as a platform that you're building, where I can come if I fit and plug myself in and leverage capability that you already have?
Exactly. Come on in. You continue to run the business, and this is to be fair, this is something new for us as well. In the past, we have business, we run it. Now, sort of like, okay, come on board, partner with us. We take an initial stake, and then we'll work with you and with all these resources, and grow the business along with you.
Okay, interesting. So how do you envision your holdco to grow? Do you envision the platform to continue growing and become just more profitable and more pervasive in the space? Is that the...
Yeah, I think one of the things that we got wrong in the first few years was that we were very aggressive about acquiring, right? So deploying capital was a part of it, right? And and obviously we sort of raise the capital, we need to deploy it, but not enough of building that platform. I think that's really the core of it. Now we're sort of spending a lot more time building a platform and being a lot more selective in terms of bringing the right partners on board that could truly benefit from the platform. And basically that's the sort of core of it now. We're building out. Once the goal will be sort of over the next couple of years to start showing that okay, we can now tag on and really grow these brands along the way.
Yeah. Why the US as the main market? That's what you said earlier.
Yes. When we first started, one of the biggest reasons for this was just the depth of the market, just in terms of targets, how many businesses and brands were there of all sizes. And one of the interesting parts of it was that there were actually a lot of owners of these brands in this part of the world. Right. So the idea was that we raise capital in this part of the world, we could approach the owners in this part of the world, and then in terms of the market is the US. Of course, fast forward 5 years later, US market is a bit tougher now with tariffs and so on, but still a very deep and homogeneous market to a large extent.
Yeah. Have you explored other markets? For example, the Middle East is a very young market in terms of number of babies.
Quite interesting ones. We haven't done Middle East so much. That's one of the work we're doing now to sort of build out not direct retail in the Middle East, but looking for partners that can actually take our brands into Middle East or even LATAM and other markets in there. But in terms of operating directly, we operate in US, North America, Canada, and some amount in Europe.
So it's actually interesting listening to you because right now a lot of the conversation, Europe and Asia particularly, is around the concept of search funds or ETA. So you're to some extent running an ETA model, but not so much as a fund, right?
Exactly. There's some similarities to it. Quite a lot of similarities to it, but not as a fund, correct?
Yeah. So you may get some MBAs that come and visit you when they find out about that. So after that video goes public, but I'm quite interested in different models on how to kind of grow businesses. So back to Prof B. Now, question on kind of decision making, because obviously in my kind of community, as whether you're a VC or whether you're a private equity fund that acquires companies, you're taking decisions all the time And I'm not just talking about invest or not invest, right? It goes into, do we expand, do we not expand, do we change the management team or not, do we try with the existing team? And then as you basically grow the business, I mean, there comes a time where ideally everything is in place and the business is on auto run. But then comes the exit time again. So as a private equity fund, you're always making decisions around it. Have you worked with private equity owners or private equity owned companies around that as well, or?
I worked with private equity companies, but we didn't really look at the exit itself as the main topic. But obviously in poker you make so many exits, right? Most of the hands don't go until the last card. There's no showdown. Most of the time somebody folds. Yeah. Because you realize that the main hypothesis you had with the value of your hand is no longer valid, right? You do this small test, you have a hypothesis, you test it with bets. Every decision is a bet on the future. And then instead of looking, okay, how can I make this work? It doesn't matter, it's gone. I have to fold it, I had to get out of this hand very quickly, right? Losing a hand is part of the game. It's a portfolio of hands that matters. Even an amazing poker player cannot win every hand and shouldn't win every hand, right? So it's, and the element of luck with every single hand is huge, right? But if you look at a longer time horizon, the element of luck is drastically decreasing. Yeah. If you look at the whole career of a professional poker player, the luck element is almost gone.
Yeah, and to some extent, I mean, that comes back to private equity. I mean, we've had over the last 20 years here in Asia a lot of first-time funds, right? I mean, so a first-time fund, you have no history, there's nothing to get on, right? I mean, all we have is individual deals. By the time you get to fund 2, pretty much still the same. Fund 3, different story. By now you have basically exits, we can see what you have done. Once you have fund 4 or later, it becomes very clear whether you're really skillful in finding good companies, growing good companies, and exiting them again. So similar, another analogy to poker, right? The longer you're in the game, there is a reason why certain investors also saying we just don't do early funds. We don't do first-time funds, we don't do second-time funds. We wait until they're in fund number 3 because we just need to have that certainty. From your point of view, anything that private equity could learn or should be aware of, could take away from one of the poker seminars that you potentially would be running?
Oh, there's so many. So where do I start?
Pick 2 or 3. So
it's to me, one of the biggest learning is really about you have to every day sit down and analyze your most important decisions. And have trusted partners who you work with to get an outside view on these decisions. It drastically changes how you make decisions. Having a decision diary, it's very, very useful. So recording, okay, what was the decision I made? Why I made that decision? What the information I had? What is the expected outcome? What is the probability of that expected outcome? And then you can go back after that happens and see and record it. And then over time, you can fine tune your probabilistic thinking. Because thinking in probabilities, thinking in bets, that's one of the biggest thing that you can learn from poker. And in every single decisions, if people don't use probabilities, then it's a failed approach.
Okay, very interesting. I think this is an interesting message, particularly for the venture capital funds listening, right? Because there you have very little information, right? And you're exposing to drastic risks. So probability of from a portfolio point of view as well, not just one hand, right? But all the hands that you're playing or folding.
Yeah, every single decision should involve thinking about probabilities.
Okay.
Having actually been in Balazs' class before, I think the other one is that's quite interesting is around the misattribution side of things, which is like you made a decision, it goes a certain way, and you misattribute it. And this is true, like even for ourselves, we sort of acquired something and said, hey, this went well, right? Like, and this had this attribute, the character. So let's do more of that. But oh wait, this doesn't work. Right? So that's the sort of like that side of things that I think is sort of quite important.
So question not
Yeah.
just why did it go badly,
Yeah.
but also why did it go well, right? Actually, from a risk management point of view, we've in finance plenty of cases where financial institutions, funds, in hindsight, should have questioned why a division or department outperformed against all odds. Right? I mean, it usually ends up being, I don't know, something under the table, in the drawer. So usually it will come out in the wash, but in theory, someone should have questioned it much earlier on because it was against all probability. It's a really good point. Absolutely.
And let me go even further with this, right? And using JJ's example, that let's assume he wants to acquire a new business. And before even acquiring, doing a mental time traveling is amazingly beneficial, right? Thinking about, let's assume we acquired this business, and 5 years down the road, we had to close it down. We lost a lot of money. It was a disaster. And let's work backwards. What happened? What did go wrong? It can have two really serious impact on the business. One is that we can realize, okay, we shouldn't even touch this business. And the other thing is we can realize, okay, these are the traps. We should think about what we can do now to mitigate those risks.
Yeah.
And do the opposite as well. Let's assume it's overperformed. It's our best bet so far. What did we do differently than what we usually do?
Yeah. I call that a premortem.
Yeah.
So I force some of my clients to run premortems. So because we get so excited about the upside, right? I mean, it's easy to fall in love with your own press release, right? But forcing things, you got to close it down. Especially, I find large corporations have a really hard time actually engaging on failure or the idea of failure, because if you think about it on any board, usually failure is you immediately go from failure to how can we mitigate it, right? So it's all about mitigation, which is what boards should do. That's fine, but forcing like we will shut it down in 5 years' time. Let's make a list of where are the potholes, where are the hurdles that we didn't overcome. So absolutely. So very, very, very interesting. Now, I have right now 100 MBAs in my class, okay? So if you could think back to 20 years ago when you were here at INSEAD, right? So what would you, as successful entrepreneurs and businessmen, what would you advise them? So all of them are sitting, as you will remember, what do I do? Do I join a large corporate? Do I go into consulting? Do I start my own business? Do I basically do kind of entrepreneurship through acquisition? So all those questions are going through their head. If you would have to give them like one or two things of advice, so I don't mind who starts.
I don't know, I can go, right? I think
Go.
probably I would say put yourself in a career path or make decisions where you put yourself in a situation where you're able to make decisions, a lot of decisions, right? Like in a time. I think sort of like, and a bit back to sort of the poker thing, sort of hone your sense and judgment by actually being in a path, in a job or in a career where you can actually make a lot of decisions and look back and learn from it. I think that's probably one of the most important things rather than having a big name or badge in terms of the sort of employer. But I think even in small organizations, if you're put in a situation where you can do something, learn from it, okay, feedback and do something else, you build a very valuable thing, which is judgment, right? Like in the B school environment, you learn it through cases, but it's not as real as being in real life and you have the sort of like real battle scars.
Yeah. Losing real money or having to shut down real businesses. Correct. So absolutely.
I would say really understand your goals and why you have them and challenge them, right? So being on the Dean's list is, no matter what, is the wrong goal, for example. Being the same kind of selective aggression on what is important for 10 years down the road, right? Networking as much as possible with alumni, with your classmates, with the professors. That's going to be probably the most beneficial. And even with classes, which are the ones that the career I want to have are the most beneficial, and put extra effort on this and do the bare minimum on the rest, right? So it's the same kind of folding bad hands that are not relevant for you and really putting more investments, raising the stakes on the relevant ones.
Very interesting. So first, let me say thank you very much, both of you, for our time. That was fantastic. I really enjoyed that. And you mentioned you're going to be running one of the workshops for the alumni here for the first time in many years.
So I done probably 2 years ago, but in the past, before the pandemic, I've done probably 2-3 times a year for the alumni here in Hong Kong as well. So yeah.
They're very lucky, so I can't wait to hear from them. And JJ, you're right opposite campus, so expect a whole trail of MBA students coming over there at one point to have a conversation. Thank you very much. So this was the first panel that I was running, so I look forward to have all the other vintages of alumni here in the studio with me. So thank you very much, and if you like that, subscribe below. Thank you.